What's up, guys? It's Mark Lewis, your favorite mortgage nerd. Today I have a very special guest, Mo the Buffalo. He's going to help us talk about mortgage points. Mortgage points are fees you pay up front in exchange for a lower interest rate, or what they call buying down the rate. 1 point is equal to 1% of the loan amount, and it's typically going to get you about a 1/4% lower rate for that 1 point. For a $300,000 loan, say the market rate is 4.25, you could pay $3,000 and knock that down to 4%. That's going to save you about $45 a month on your monthly payment.
So should I pay points?
That's a great question, Mo. I'm glad you asked. The way you figure this out is you look for the break-even point. The break-even point is the point in time where the amount you paid up front is equal to the amount you saved by having a lower monthly payment. Typically, this is going to be 5.5, 6 years into the loan, but it can vary, and the amount of points that you need to pay to lower your rate an eighth or a quarter can vary as well. You're in the red up until the break-even point, after which you start saving money. There are also negative points. And negative points is when you actually take a higher rate in exchange for credits towards closing. But let's say instead of 4.25, you take a 4.5 and you get a $3,000 credit towards closing costs, but your monthly payment is now $45 higher. In this scenario, you're going to be ahead for the first 5.5 years of the loan, after which you start losing money at a rate of $45 a month. Again, scenario 1, you paid a point. After 5.5 years, you break even. After 11 years, you saved yourself $3,000. Scenario 2, you took the negative points. After 5.5 years, you break even. After 11 years, you paid an extra $3,000. And of course, there's scenario 3, in which case you just take the market interest rate, pay the normal closing costs, and go about your day.
So what you're saying is points aren't good or bad. It just depends on people's individual situation, right?
That's correct, Mo. But at least they know how it works. So anyway, I think this is interesting because what it means is you can actually save money by taking a higher rate. If you plan to stay in your home,
Less than 5.5 years.
here's some ideas you could do with that extra $3,000. Install a hot tub. Throw an epic housewarming party. Get an outdoor hibachi grill. Build a tree house. Or do literally anything with it. Sell the house before 5.5 years and you win. Thank you guys so much for watching. Mo and I had an absolute blast, isn't that right?
Yeah.
Awesome. So we're going to continue to provide educational content. I hope you tune in because as many wise people have told me, you don't know what you don't know. And you just might learn something that saves you thousands of dollars or helps give you an idea for how to better plan your debt strategy or your mortgage strategy and accomplish your long-term goals. Hope you have a great night. Peace.